All right, Tom, you are back live and direct.
Yeah, live and better than before. Okay.
Okay, perfect. So we left off. We were trying to get a brief intro from you. How long you been in the industry, and then just give us a little background of yourself.
Well, I jumped into industry in 2018 after 35 years in tech.
In tech, I gotcha. And what was the reason for the move?
Well, you might have seen one of the reels I posted about earning about $1 million in 2017 and then losing about 400,000 of it to taxes. I said I didn't want that to happen again. I started digging into some financial solutions, and that landed me here. And I decided that, yeah, I could do this instead of going back to the W-2 grind. I could be self-employed and enjoy helping other people with finances. Yeah.
Gotcha. So you were one of the people that actually felt the loss. What year was that when you experienced the? How much was it? What did you say?
Tax year 2017, federal and state combined was close to $400,000.
Wow. So
Yeah,
you
so I paid my fair share.
you were tired of giving your hard-earned money away.
Well, I live in San Francisco Bay Area, and there's 3 bridges in the area.
Mm-hmm.
If you go clockwise around the bay, like you go over the Golden Gate north, then you come back over I think it's bridge, yeah, that's it,
Yep.
and then come back down over Benicia. If you go
Yep.
clockwise around the bay, you pay no tolls. If you go counterclockwise, you pay tolls. So what is that about? You're not evading tolls by going clockwise, and you're not evading taxes when you properly arrange your finances. It's called avoiding taxes when you don't need to pay them.
There we go.
Yeah.
Yeah, and that just comes with the plan in place. Like you said, just knowing, being from the Bay Area, if you go a certain direction, you will, number one, be either taxed or non-taxed, and it's really up to you on the route that you want to get there. Similar to the financial realm, to where if you know of a strategy that you can legally be in a tax-free category, it may be in your interest or your best interest to put yourself in one of those categories. Because I know there are a lot of investments out there that are going to be taxable, and then there are very few that are tax-free.
Right. And yeah, I would say tax efficiency, that's something that you and I think, are really interested in, because in some cases you can avoid taxes, but how can you be more efficient? And certainly I don't want to face tax bills like that in retirement. I'm closer than retirement than you are, obviously. You might see my gray hair here.
I thought I was going to beat you in that race, but I guess not.
Yeah. Maybe you can retire early with all the money you're making. Okay, so but I do know that there's some of that money I earned, I just couldn't avoid the classification. It was RSUs, et cetera, stock options, things like that came in and were accelerated, so they became income in that year I left that company. And you could look me up on LinkedIn if you want to see some of my background. Thomas-Southard, Thomas-Southard, S-O-U-T-H-A-R-D. I'll spell it really fast, S-O-U-T-H-A-R-D. Okay, anyway, what could I have done different to avoid tax on that? Nothing. But if I had a tool that I have in my toolbox now, I know I still could be making money on that $400,000. Do you know what I'm talking about? You want to talk about that?
Yeah, so just to recap, you had a nice large lump sum payout from your previous employer, and 400,000 of that was paid to the IRS because of the amount of income that you made in that specific year. You're saying that 400,000 is now unable to work for you forever going forward, and there is a way to actually, let's say, put it into a system where you'll actually retain the value even though you did pay off the IRS. And that's specifically what we like to refer to as the IUL.
Yep.
Some of you may have heard of it as called as the flip method, meaning we're able to put active income that we make into a policy where it's going to retain the value, and then we're able to take a loan from it and actually pay whatever that may be. In his case, $400,000 worth to the IRS. This may be bills. This may be other assets. But no matter what the solution is in your case, being able to utilize your same dollars in 2 places is pretty much what we wanted to get on here and just answer a few questions and give some examples of the experience. Tom, you want to add anything to that?
Yeah, fast forward from 2018, so it's been 8 years. There are certain IRS rules about life insurance and IULs that cap what you can put into a policy. And we're able to use techniques that a lot of insurance, probably 99% of agents don't use. Certain MEC test, I'll just say it, CVAT, we use the cash value accumulation test. After 7 years, you can put as much money you want. Up until then, you're limited by how big of a death benefit you start out with. So my policies now are past the 7-year mark. And so if I had that $400,000 today, I could, before I paid taxes on it, I could have put it in this account. And then when the taxes came due, got paid in January, 15 months later in April, I could pay out, and I would have earned already let's say 7% on average. And then not only that, but that money will continue to earn because I'll borrow it out, might borrow it out at 4 or 5%, but it's always going to be earning from then on. So if I had done that back in 2017, I would have already made, I calculated about $250,000 on that $400,000 I had to spend. Now, of course, I didn't make anything on it in the last 7 years. But again, if I had, I would have made, let's say, if it's a 2% difference compounded, it would have made about $250,000 so far. So that's the kind of thing we want to do. We want to, every dollar that passes through our hand, we always want it to make money for us in the future.
For sure. You put a lot of things out there that some people may not know the context to. You said that there was a limit for, let's say, 7 years in this policy that you're discussing. Who is the one that dictates the upper limits of a policy?
Well, the IRS has rules on that. And they're saying this came about in the 70s. They decided that too many people were taking way too much advantage of these cash value life insurance policies. So the IRS wants to make their money. And so they said, okay, if you want to put this much money in your policy, you have to be buying at least this much death benefit. And so what we'll do is we'll try to get the least amount of death benefit for the most amount of money we could flow through a policy, because that way all the excess beyond what's going for the cost of the policy can be earning money.
Yep. And why do you think the IRS of all people has the capability or the judgment to put a governor, if you will, on these policies?
Well, okay, I think I got where you're going. This money in your policy grows tax-free. That's what you wanted me to say. The money goes tax-free. And not only that, but in the future, when I want to access, if I had that $230,000 that grew in that account, I could access it today, tax-free.
Yep. And
when I say access, I would borrow it. But people go, oh, it's a loan. No, it doesn't show up on your credit report. Why? Because it is what kind of loan? It's a non-recourse loan. It's collateralized against your death benefit. Your death benefit will pay it off. Let the insurance company pay your debts for you. That's what
exactly. Money that you're able to utilize the money tax-free. It's not going to be reported on your tax returns at all. And you can literally utilize those funds indefinitely as long as there is cash value growth in these policies. And that's what Tom really opened his eyes to when he experienced the tax hit that really hit for $400,000 a few years back, almost 10 years ago now.
Yeah. So, Anthony, do you talk to any young couples, young families that have kids maybe that are 5 years old or maybe younger? You talk to families like that? Yeah. So if they're thinking about financing college education in the future, they might have to fill out a FAFSA form to see if they qualify for any financial aid.
Yep.
I filled it out the first year for my 3 kids, and after that I didn't fill it out again because I just didn't qualify. I just made too much money. And okay, fine. But if you want to save up for college education for your kids, when you have that savings, that will be counted against you on your FAFSA form for that college education. So
the money that they save,
because you prepared yourself and you prepared to finance your kids' education, you won't qualify for certain programs or grants because you have too much money. Well, if you put this money in a life insurance policy on your kid, for example, and then later when they're in college, you could be drawing out of it, and that will not count on the FAFSA. That money in your life insurance doesn't count on your FAFSA.
So basically, we're getting penalized to save in, let's say, a 529 plan.
Yeah, 529. Yeah, don't use those. They're too limited. That's the other thing. When we talk about things like IRAs, Roth, 401ks. There's a lot of liquidity restraints on those policies, where you can spend the money, when you can spend the money, or what you might get 10% penalty if you access it too early. That doesn't happen with cash that's accumulated in a cash value life insurance policy.
So a lot of these government plans that are out there, it sounds like they limit the amount of money you have access to, where you can utilize the funds, and they disqualify you on other government aid in the future if you were to send your kid off to college to better themselves.
Yeah.
Is that true?
Yeah.
It sounds like on one note, they're saying, hey, this is a good deal. And then when you actually need the funds, it kind of gets flipped upside down on you.
Yeah, there's just a lot of advantages of using cash value life insurance. A lot of people have heard about become your own bank, right? Or infinite banking concept. And the flip concept takes the infinite banking concept to the next level. It's like hyperfunding it. And so you don't have immediate liquidity. Typically, if you want this policy to start generating funds, for example, I had a young client in the 30s. Their housing cost was about $30,000 a year for the mortgage, utilities all in. Gotcha. And they had an extra about $15,000 that was not earmarked for anything. They already matching their 401k. And I said, let's take $6,000 of that, match it with the $30,000 you're paying for your mortgage. We'll put $36,000 in the policy every year, but we'll take the $30,000 out every year to pay for your expenses on your house. So you're out of pocket each year $6,000. We'll do that for 7 years, and then for 8 years we won't do anything other than put money in and take it out. And then by the 15th year, after the 15th year is done, and you're all in it, 7 times 6 is 42,000. Yeah. Over a 7-year period. After the 15th year, it's going to start spitting out enough money to pay the mortgage. And then
you basically showed them a way to cut a 30-year mortgage into a 7-year.
Basically, I turned a 30-year mortgage to 15 years. Not only that, and of course they also have life insurance. So if they die, there's life insurance to pay off the loan so the spouse has money. But when they get to the retirement age, let's say 65, they can start taking out an extra $200,000 a year and as much as $500,000 a year by the time they're 85. All from that 42,000. Just in 2 years, the 16th and 17th year, it's already made back the 42,000 they put in the first 7 years. And
that's really going to be the magic of compound growth and never really spending your money. You're literally leveraging your money and spending the insurance company's money in this case. We do got some questions in the chat over here on the TikTok side. I'm going to just read these off for us. If I pull out money, including growth, is it tax-free? You want to answer that?
Yeah, well, there's 2 ways you can take money out of a cash value life insurance policy. One is by withdrawal. Yep. And 2 is by loan. Mm-hmm. Withdrawal, you typically don't want to do because you're reducing the account value permanently. Also, there could be tax consequences for that. You want to take loan because what happens is you have 2 different accounts being tracked in the, let's say, ledgers. Yep. You have the account value, which is all the premium going in. That's what you pay for the policy on a whatever regular basis. And it could fluctuate how much you're putting in any given month. And then minus any of the expenses that are related to the cost of the insurance. And that's your account value. And that's going to get credited. It could be monthly. You're getting credits on what's happening in some market activity. You know, it could be linked to the stock market with a 0 floor. So you never lose, but it's on average, it earns about 7%. All right. So the question is, can you take it out? Yep. You can borrow it. You want to keep a buffer in there because you can borrow it out at any time as long as there's enough there for you to borrow. There we go. That's the short. So you do have access to it and it will be tax-free. If, like you said, we typically like to utilize the loan because if you do take out a distribution from your account, you're literally lowering the value and not giving yourself to make interest on it going forward. So yeah, don't take withdrawals. That one there. No withdrawals. Yeah. And then let me see, we got a lot more over here. And loans can be at any time, you know. So I have a client who had an auto accident and they're waiting for the insurance payout, but it's not coming. They want to pay the repair cost. Instead of taking it out, put it on a credit card and paying 18% interest. borrowed it out of the policy at the 4 or 5%. Then when the payment comes back from the insurance company, you can pay off the loan, so that banked money is still there for you to use. That's part of the infinite banking concept, basically.
Yep. And we got someone that says the 0% floor, meaning you don't lose any of your money. Somebody pointed out you still have to pay for costs of fees for the insurance, which I always say this is going to happen no matter what. And really, what's going to be the alternative? Because where do people typically invest their money if it's not into something that has a 0% floor? Do you have any experience on this? Where do people usually put their money?
You could put it in a CD or money market account, right?
CD, money market.
Yeah, and you're going to earn
Typically,
maybe, 1 to 5%. I don't know what the rates are right now, maybe as high as 5%. You could also use government bonds, things like that. But what's happening here, though, is you're getting some additional value. You put money in a CD, let's say you're earning 5%. Let's say you put $100,000 there. You put $100,000 in life insurance policy. Not only are you going to be earning about 7% a year, but you're also, well, depending on your age, you're going to have probably too much life insurance. But that's something. Do you need life insurance? I was talking to a couple, and one of them, the income earner, was working at Apple, good salary.
Yep.
His wife was at home. I said, well, why is she at home? Is there a reason she's not out? Yeah, she's doing some homeschooling. It's like, okay. Is there, what else about that? Well, they had a special needs daughter. So, well, what will happen if something happened to your wife? It's like, well, I would quit my job. And it's like, well, so if she died, you'd have to quit your job. So you've just lost your income because you lost her. So you need a life insurance on her. And so, yeah, everyone should have some life insurance. And for younger couples, I like to go the combo approach. I don't know if you're familiar with that.
Yeah, go ahead and share that.
You hear from a lot of financial advisors that we should buy term and invest the difference. Okay.
Yep.
So I am a fan of term insurance. So for that young man I was talking about earlier that was in his 30s with the $36,000 going into policy, also have a $2 million term life insurance on for the first 20 years of his life, because that will get his kids in and out of school. By then they'll be out of college, and he's got that extra coverage. By that time, the IUL, which has only got that $42,000 funded in the first 7 years, is going to replace the term policy. That's something you can't get out of a 401k, an IRA, a CD, a government bond. You don't get the life insurance.
Yeah.
Because death and taxes, right? Those are two things we're assured of.
For sure. And
so we're trying to deal with both.
Oh yeah. And like you said, someone working at Apple, I'm pretty sure they're making a decent wage, especially even in the Bay Area. And for them to literally tell you that they were going to quit their job if anything was to happen to their wife, that tells you the value of a stay-at-home mom. Even though they may be just staying at home on paper, not receiving income, how much money are they going to be saving you by taking care of the household, making sure everything's clean, cooked, the kids are where they need to be? And in that situation, they had a disabled daughter, and if something does happen to the wife, what happens to the daughter when the dad's at work? You're going to have to get in-home care or send her off to like a daycare daily, and that's a bill in itself.
In a business, this would be called a key man policy. So if you have a right-hand man, woman in your company, and if something happened to them and it would totally disrupt your business organization, you would take out a life insurance policy to help protect your business. This is the same thing you want to do at home. You have a key family partner policy. I was thinking about the term leverage. You're familiar with leverage, right?
Oh yeah.
Most people use leverage to buy a bigger home than they can afford on their own. So they get a mortgage, right?
Yep.
They borrow a loan and secure the mortgage loan against the value of the house. I want to go back to what you said, when I got into this life insurance business, I was introduced to something called Kaizen, which was premium financed life insurance, and probably something most people have not heard of. And what this means is I borrowed money from the bank to fund my life insurance policy. And the bank was happy to do this because they knew they had a guarantee, because they had my death benefit and they also had cash value that they could secure in that policy.
Yep.
But
So
what,
they had the death benefit if anything was to happen to you,
yep,
and then they also had the cash value that was growing in that policy that they were the ones to actually front the money as a double back security, meaning if anything was to happen either to you or to the deal, they still had their money. There was no risk on their end that they were
yeah, they had no
partaking.
risk. They had no risk.
Mm-hmm.
And so um, when I started looking at with one of my fellow engineers here, who used to work at Taiwan Semiconductor, he showed me how I could do the same kind of plan, but without all the handcuffs. So this premium finance plan that I was doing had a lot of handcuffs to it. I had to put in this case, the way I programmed it, $100,000 a year for 5 years. The bank was matching that, and then for the next 5 years, the bank took my match and their match together. So it funded it for 10 years, couldn't touch it for 15 total.
Gotcha.
And so it became this really locked up plan. And what you and I have discovered with Flip, we're self-financing. We're premium financing our own policies by putting all of our expense money in and then borrowing it back out. The loan, instead of from the bank, is from the life insurance company.
Yep.
And so we're using leverage to buy more life insurance than we can afford and to accumulate cash value for the future that can be accessed tax-free.
Exactly. We got a question over here that says, why would I want to loan my own money?
Okay, try to go out right now and get a loan.
Try to go out right now and get a loan.
Right. So one of my friends just got a loan for a car he bought, 8% interest.
8% interest, yep.
Right. Would you rather pay 8% or 5%?
5 all day.
Okay, yeah. What if you had already had you had $50,000 in your life insurance policy, and you borrowed against that? You didn't borrow it out. It was still earning 7%, and you're borrowing at 5%. So that 50,000 is still making on average 2% forever,
yep.
Compounded, and probably more, because we see the spread between 2 and 5%. This last year, my one policy, the least amount earned on any segment, it was earning. So each segment matured every month. There's a new segment depending on how much the money going in. The smallest I earned was 7.5. The highest I earned was 18.65. So I was earning well above the average 7%. But there'll be some years that will be lower than that.
Yep.
But the spread between the loan and what you're getting crediting is on average between 2 and 5% is what we studied. And I think because of some of the strategies, you get to choose which index strategies you're using in your policy. And the one strategy I was able to choose in this one account is really performing well.
I got you. We got someone over here, a heckler. He goes, you guys are playing with money and making it sound like a deal. You see this in different avenues because it's not just insurance that knows the power of leveraging. It's also in stock markets. You see someone like, let's say, Jay-Z and Beyonce, they have a lot of money. They're billionaires as a couple together, and they recently bought a home on the West Coast, and they took out a mortgage for a few $1,000,000. They're worth $1 billion, but they took out a loan for $1 million. And why would somebody do this? Why would you not just pay the full amount in cash?
Yeah, I can imagine that they're able to invest that money and see returns far greater than the interest cost on their mortgage.
That's exactly
liquidity. Liquidity is as well as cash flow is really what matters.
Exactly. So they bought a piece of real estate, and instead of spending their own money, they're going to borrow the bank's money.
That's right.
Why? Because the bank's going to give them cheap money as opposed to having to liquidate whatever their funds are at right now, pay down a full value of a house, and not earn interest on that money anymore. Same thing, you have Elon Musk, who owns plenty of shares of his own company, but instead of selling shares to go buy other assets and fund his lifestyle, what you'll see him do is get a note from the bank saying, hey, I have this much stock worth this much money. Give me a loan today so I don't, number one, have to pay taxes, and I can still be liquid as far as have my cash available to do what I want and not really have to bypass these tax loopholes, because when you sell, typically it does incur a capital gain. There's a strategy to this, and you see this in different avenues as far as industries. This is just one of the ways that you can utilize your own income and being able to leverage it in two places, because where else can you do this besides somewhat like the IUL and not be taxable? Because you can do this in other places, but literally this is going to be one of the only ones where it's not going to be taxed and there's no strict repayment terms. Meaning, if you took money from your 401k, number one, you're going to be limited on how much you can take. And when you do so, they're going to mandatorily make you pay back the money that you borrowed. They're going to make you pay back your own money, which that doesn't sound too smart if just looking from the outside looking in. If I was to give my money to somebody to manage and then they're going to tell me when I get to utilize it, I'm not going to know how much is going to be taxed. And the growth is not certain. Yes, it's been a great accumulator of wealth, but it may be one of those times when the market dips when you need the money the most. And that's literally one of the things that I tell you: don't sell when the market is red. So you don't really have control of, let's say, that roller coaster ride that you're on.
Yeah, I was thinking about how there was a question earlier. Why would you borrow from yourself? Well, if you did have 50,000 in your life insurance policy banked away and you wanted to buy a car, you could borrow out as much as you wanted to pay off that car. Let's say it cost 50,000. So you borrowed 50,000. You don't have to pay back that loan. If you borrowed from the bank, you'd have to make regular payments or it would be repossessed.
It would be
There,
that's one of the questions that we just had over here. Even loans that you make, you have to pay back. Um, Now, he is true. The loans have to be paid back. But what two options do you have as far as paying that loan back?
death benefit.
So you, number one, have the death benefit, meaning you can wait until you die and all the loans are just simply just going to come from your death benefit. Meaning, let's say if someone had a $500,000 death benefit and they used during their lifetime $200,000 of the cash value that they grew in their policy, $200,000 is owed plus interest to the company. So when they pass away, the first money that is going to be paid from that death benefit is going to be money back to the company plus interest. So let's say if it was 250,000 in total, including the principal plus interest, the remaining 250,000 would go to beneficiaries. Or I was just saying that there's two options. You can either let the death benefit pay your loans back, or you can pay your loan back yourself while you're living, and it's simply just going to add more equity to your account that you can buy, borrow, repeat method, to meaning you can put more money back into your policy and leverage that money back out, buy other assets, utilize it for vacations, paying off debt, whatever you want to do. The money's yours. There's no strict repayments or anything like that. You have access to the capital that's in there, and from there, it's just going to continue to grow. Whether you use the money or not, it's truly up to you.
Yeah, and the example I gave earlier of the young 30-year-old putting in 42,000 and in retirement getting 500,000 a year. By the way, even though taking $5,000 a year in tax-free loans, the death benefit is exceeding $2 million net of loans, net of the loan. So there's still a death benefit even with loans in place to be paid off.
Exactly. You just continue to build an asset, and you can look at it as you have an asset that's going to out earn not only the loan, not only the cost of insurance, but also have growth in your monies, but also a death benefit if anything was to happen to you, because it's not if you die, but when you die. And this is just one way to utilize your funds to build up an asset while utilizing them. Not many other places can do the same. and that's what we're here to educate on. I'll let you go. It was nice having you on, and then most likely let's get back to this hopefully in a week or so.
Yeah, that sounds great. Hey, thanks for inviting me. Appreciate it.
All righty,
God
have a good
bless
one.
you. Take care.
You too. Bye.